The Federal Reserve Board expected to keep interest rates near zero for now, continuing despite continuing inflation. An announcement from the central bank is expected early this afternoon after the board wraps up its two-day policy meeting. But market watchers predict that the board chair, Jerome Powell, will signal a plan to raise rates at the board's meeting in mid-March. To tighten credit even further, the Fed plans to end its monthly bond purchases in May. And later this year, it may start reducing its huge stockpile of Treasury and mortgage bonds. Joining us now to break it all down, tell us how to prepare for that rate hike, founding partner and CEO of wealth management group, Craig Bolanos. Lot to unpack there. Welcome in, and where do we begin?
Well, we got to begin with what everybody already knows, the inflation for us as consumers. It's stubborn and it's more persistent, and consensus now is we've got to do something, at least on the monetary policy side, to start getting things in line, and that's got implications for savers, investors, and all of us as consumers.
But the timing is so delicate. So they wanted to boost the economy, they held the rates low, then inflation went out of control. Now to combat that, we need to raise the rates. The timing is really key. So when do you see this happening, and how soon do we as consumers have to worry about it?
Well, if you hold me over into the next news break, I'll tell you, because right after the 1 o'clock hour, we got the big announcement with JP himself, Jerome Powell, who's going to address the nation and bankers and give us some insight as to what the pace of these three different programs that you mentioned, Patrick, raising rates, rolling off assets, stopping the bond buying. We'll figure out how that plays out, but I likely think it all starts in March, and there's some things that all of our listeners have to start taking into consideration today, not next week, to get prepared for this event, because we haven't seen rates move up since 2018.
It's a lot of spokes to this wheel. Investors on Monday started hitting the sidelines because of inflationary concerns, but then people who are in the housing market, this affects them as well.
Oh, absolutely it does. I mean, Patrick, we've been sub 3% mortgage for a long time, and all this stimulus has fueled double-digit home prices, but a lot of analysts are predicting that by the end of the year, not tomorrow, we could see a return to what might be a 4% 30-year mortgage, and that hasn't been around since 2014.
Okay, so people maybe, if they were considering refinancing or even buying a home, it seems like now's the time.
Yeah. Now is the time for your mortgage. Look to get better terms and conditions, lock that in. But think about the avalanche issue in America today, student loans. Everybody has them. People want to know what to do.
You know, there has been some comparison to things that haven't been this bad in 40 years. I can remember back in the early 80s with my mother and father speaking about interest rates in the teens, right? Mm-hmm. So is that a fair comparison? Is it apples and oranges, or is it right on?
You know, it's actually not apples and oranges. Now, what I will say is this. I mean, we just had this big inflation print, and it's a scary number. The number was 7. You got to put it up on two hands, right? And that was the biggest inflation print since 1982. But this is not a return to the 70s with hyperinflation. No one's going to have double-digit mortgage rates, and we're not going to have passbook savings in the 12 to 14% like the time I was on the Bozo show back in 1980.
So I want to address, you mentioned something about student loans, and obviously they could refinance some of the people that owe their student loans at a low rate now before interest rates go up. But if there's any loan forgiveness, then they're not eligible, right?
Oh, such a balancing act. Here's what I think everyone should do. If you have federal student loans, do nothing right now today, because right now you have 0% interest and no payments all the way through May because President Biden extended the student loan forgiveness. But if you have private student loans, it's a different story. Let's work right now with a good bank, a good loan consolidator, to improve your terms and conditions before the cost to borrow goes ahead.
So in other words, reach out to them and try and negotiate something in the meantime.
That's just it. You got to shop. As a consumer, you know, protect your FICO score, work on your finances, present a good argument, and then you just have to be active and shop around for the best deal for your particular circumstance.
Real quick, what is the tell with Jerome coming out this afternoon at 1 o'clock? What is the most significant of his remarks that will be coming?
Well, first, I think Wall Street would be surprised if there was a rate hike today. That'll rattle markets. We're rallying into the announcement. I think all we want to hear is The first rate hike will be gradual, it'll be measured, it'll be data dependent. We want reassurance right now that the Fed is out of its quiet period, and that should settle down markets and give all of us a better picture as to the changes we need to make.
Thank goodness, because they've been plummeting lately.
Thank you, and check out Wealth Management Group and Inverness and Downers Grove online and invest with WNG.com. We will be right back.